Hey, what is going on, everybody? Welcome back to Bonafide Investing. We discuss all things high yield investing, options and futures trading, and just setting goals for our portfolios. So, what we've done so far, we've kind of discussed the portfolio, the reason for it. The goal is to live out of my brokerage account, pay the bills, and hopefully grow it and pay down margin debt along the way. What I want to do today, I just want to look at a couple holdings in the portfolio. In past videos, we've so far looked at TLTW and SGov, my short-term treasury and long-term bond exposures, why I hold those. We've discussed CRF, Cornerstone's Total Return Fund. Today, what I want to talk about are my high yielders, I would call them ultra high yield ETFs, WPAY and YMAX. Why they are in the portfolio, how I use them strategically, and also why I would never put all of my money into either of them. So why don't we dive in? Before we do that, let's look at some stats briefly here. Right now, we're sitting at just above 380,000 on the portfolio, using a little over 122,000 in margin as well. And my margin buffer currently sits right around 60%. So if we dive into WPAY, what is WPAY? WPAY is Roundhill's fund of funds. What they do is they hold, I think currently, last I checked, it was 21 single ETFs, names like Palantir, names like Costco, names like NVIDIA and Tesla. So a lot of tech exposure, very heavy tech exposure, as a matter of fact. The nice thing they just did, though, they just added exposure to Uber, Costco, as well as ARM Holdings and Alibaba, which was nice to diversify out of that really heavy Mag 7 exposure across their holdings. Right now, WPAY has been a decent performer. It's a very high yield fund. I've been getting anywhere from roughly 35 to 38%, all the way up to 75, 80% annual distributions. And they pay weekly, which is really nice. So they go ex-dividend every Tuesday, and they pay every Wednesday. As a matter of fact, I think I have down here an $837.55 dividend coming in that will hit my account today. So I've averaged cost just right around $50. It has come down some. We had that 5% market sell-off. When I did rebalance on Monday, I was able to sell some shares for right around $47.50. They did come down yesterday, obviously because of that high distribution. And that's something we'll discuss as we go to the NAV erosion component. So I own WPAY. Like the diversification, I have to sit here and try to hold all of the ETFs are the ones I want to hold and track in equal proportions. So this really helps me kind of own just a broad basket of high quality companies. Now, the risks I see in WPAY, first of all, is NAV erosion. WPAY is a newer fund. It has not been around very long. I really like what the folks at Roundhill are doing. I've liked the management so far. I have personally found them to be superior to other high yield providers. And one thing I want to look at too is the total return on Robinhood. So minus 6.75% is not accurate. Last I looked, I was up about 1% to 2% total since opening a position in this fund. Because again, a lot of the return will come in the form of distributions. So why use it? Why use it if it falls, right? Well, yeah, but WPAY is a leveraged ETF, so be mindful of that. They will get 1.2% exposure or 120% exposure, however you want to look at it, for the holdings, okay? So that means if markets, the holdings perform positively, you're going to get about a 1.2 positive return in relation to the underlying. And if they do poorly, you're going to get about a 1.2% performance to the downside, right? So it is leveraged. So I'm very mindful of that as I trade it. My goal is to keep this position about 15% of my total portfolio. This provides high weekly income for me. So it helps me pay my bills, pay down my debt. What I'm also doing is I'm dollar cost averaging into it $30 per day. So you can look here that I'm dollar cost averaging $30 every market day. So that's about $600 per month. So I'm putting back a little bit into the fund, which will help hopefully offset a little bit of volatility across the holding, as well as lower my cost basis as we go, as it falls potentially. Now, WPAY is also pretty tax efficient. You get the majority of your distributions so far as return of capital. So what that is doing is basically giving you your money back on paper, right? And come tax time, it should be a better tax situation, assuming you're holding the position, because you're not going to be paying taxes on it straight up front. So again, as I always remind all the viewers, never tax advice, never investment advice, not in this video, not in any future videos, educational purposes only. So please seek out any of those tax issues or tax questions to a professional. So currently sitting 1,578 shares. I'll be buying, like I said, $30 more today. It was about a 60% annualized distribution on this week's payment. It had been a little lower the past few weeks, as it had usually been. I think that had a lot to do with the short-term market volatility we saw with that sell-off in November. So with all that said, again, the high distributions will help me pay down my margin debt. This is the only holding that I have that has a 30% maintenance ratio. So it does eat up a little bit more of my margin. All of my other holdings across the portfolio are 25%. So that low, nice maintenance ratio, making sure that I can keep that buffer, my margin buffer, as best I can. So WPAY, this is why I use it. The high yield produces that cash flow, which I can pay the bills, pay the margin down. And I use WPAY with another fund by YMAX called YMAX. YMAX has been around a little bit longer. I think YMAX is going on almost 2 years now as a fund. And this is another one that I want to be very mindful of NAV erosion, right? It has definitely fallen since I bought it. I've got an average cost of $12.65, but it's also paid me enough distributions, which have offset that 15.77% decline. So the high weekly income, just like WPAY, YMAX goes ex-dividend on Wednesdays and pays on Thursdays. So I'll get those distributions on Thursdays a day later. But that high weekly income with WPAY is paying down my margin and helping me live out of my brokerage account. The goal for YMAX is a 5% allocation. YMAX is not leveraged like WPAY, meaning it's pretty much one-to-one with their underlying ETFs. YMAX holds a larger basket of single ETFs within their offerings. So you get usually closer to 20 to 30 holdings across YMAX, but there is a lot of overlap, right? So as we looked at in a past video, why do I like to sell puts and calls on blue chip equities, on blue chip stocks and utility companies, those safer companies, is to offset a lot of that concentration, that heavy concentration in tech. YMAX has some gold miners exposure, which I like, whereas WPAY currently does not. And YMAX is paying some weeks right around what WPAY is paying, right around that 50% distribution mark. Overall, though, since WPAY's inception, YMAX has yielded a little bit lower. But what I've also seen is it had a milder sell-off during the November 5% roughly market correction. So 5% for this allocation. I am dollar cost averaging into YMAX $10 per day. That $10 again goes with the overall $200 that I've been dollar cost averaging in every market day. So the 5%, $10 of 200 will hopefully keep me rebalanced, lower my cost basis, and have a slight volatility hedge as I reinvest some of my distributions back into YMAX. So again, this is a synthetic covered call strategy as well on YMAX. WPAY will have direct exposure to the underlying holdings, right? They'll own across their portfolio the actual securities, whereas YMAX will not. YMAX will use treasury bills and then write synthetic covered calls to generate the high income. So something to be mindful of as well. Those are my two heavy hitters. They are providing me it fluctuates weekly, but they're providing me the bulk of my income. Last I looked, it was YMAX is paying me about $14,000 annually. WPAY is paying me about $45,000 annually. So right around that $60,000, $55,000 to $60,000 mark between the two holdings. So they are, again, the bulk of my income generation. I would never put all of my capital into these because of the NAV erosion issue that they do experience, meaning that they're going to fall with the market. They're going to fall hard when the market falls hard. At least what we've seen so far, right? There's no guarantees how things perform, but when markets do recover, when we get that bull market back, these do take quite a while to regain that NAV, to start climbing with the market, because again, you're getting that distribution up front, right? There's no free lunch. I've said it before. So you get the trade-off of income over the growth. So be very mindful of that. These would not be two funds that I would buy for growth. I do buy them strictly for income. So looking ahead today, we've got the Fed meeting. We should have that. What I imagine is going to be a 25 basis point cut. That should be announced here later today in a few hours. Interested to see what Powell has to say. The Fed outlook. I think markets are very reliant on Fed policy, especially right now. And I should be making some changes here to the portfolio. I've contemplated buying another put on the Qs as well as the SPY, just to, again, protect more of my portfolio to the downside. Currently, across all of my longs, I'm looking at about a 35 to 40% downside coverage only. So I want to bump that number up a little bit more. Trying to decide if I should do that now or wait till some part of Q1. But anyways, thanks for being here. Hope you got something from this video today. And on the next video, we are going to discuss the NASDAQ exposure across QDTE, QLDY, and QQQI. Thanks for your time today. Have a great day.